Is CNH a buy or a sell? Let's get started with the model. This is a large cap company, 14 billion market cap. They're trading at $11 a share, and they have 1.3 billion shares outstanding. This company designs, produces, markets, sells, and finances agricultural and construction equipment. It sells farm machinery, including two-wheel and four-wheel drive tractors, crawler tractors, combines, grape and sugarcane harvesters, hay and forage equipment, planting and seeding equipment. Their construction equipment includes excavators, graders, backhoe loaders, skid steer loaders, and compact track loaders. It was founded in 1842, headquartered in the UK. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They had a lot of free cash flow in 2021, $3.2 billion. Then negative in 2022 and 2023. I guess they were investing a lot into CapEx because they did have positive net income. They did have a small positive in the trailing 12 months, only $78 million. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that's pretty steady from $1.7 billion to $2 billion. Revenue is a sales for the company, and that grew nicely from 2021 to 2022, but it's been flat since then. Their 2022 revenue is almost identical to their trailing 12-month revenue. They do pay a really nice dividend, 4.3%, but they cannot afford the dividend payment. They only generate $78 million free cash flow, and that dividend cost them almost $600 million. They can only cover 10% of it. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $23 billion. We discounted those numbers back to today using weighted average cost of capital. We get a value of the company of $20 billion. We divide that by 1.3 billion shares. And we get a calculated stock price of $16. They're trading at $11, so they're trading at a 31% discount. It's a buy according to the model. What do you think? Do you think it's a buy or a sell? Let me know in the comments. There are 34 companies in the same industry as CNH, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They spend $1.1 billion in CapEx. Deere spends the most, $2.8 billion. They have the worst debt to equity ratio, 3.6. That means for every dollar of equity, they have $3.60 of debt. They do pay a really high dividend, 4.3%. That's second highest on this list. Look at Rev Group, 11%. It's a big dividend. They don't generate much free cash flow, only $78 million. They rank 4th in market cap. It's a big jump from 1st to 2nd, then 2nd to 3rd, then 3rd to 4th. They're all pretty far apart. Price to book is 1.8, pretty close to the median. They have a really good PE at 6.8. That means investors are paying $6.80 for $1 of earnings. They have a really bad price to free cash flow since they generate such a small amount of free cash flow. Price to sales is really attractive at 0.6, better than the top 3 companies. They generate $23 billion of revenue, 4th highest on this list. But their 5-year annual revenue growth rate is negative. Most companies are positive in this industry. The best is Alamo Group, they're at 9%. Their 52-week low is 945, 52-week high is 1313. So they're about in the middle of that right now, and they're at $10.90, which is closer to the 52-week low. So it could be a good time to get into the stock. If you put $10,000 into this company 10 years ago, you'd have $16,000 today, a 5% annual return. Not a great return, but at least you're positive. After about 6 years, you would have been in the red. This would have been a roller coaster ride owning this stock. So to summarize, I have them trading at a 31% discount. I give them a ranking of 7 out of 10. I think it looks really attractive. It's at a good price point. Would I buy it short term? 5 out of 10. Long term, I'm more likely to buy it. Ratios are pretty good except the price to free cash flow. Their PE is really attractive. Financial is 5 out of 10. Because their free cash flow looks terrible since 2021. Revenue is up a little bit, and $23 billion is a good amount of revenue. Let's look at their most recent 10Q. This is for the 3rd quarter of 2024. Here's their income statement. 3rd quarter of 2024, 3rd quarter of 2023. Their revenue went down. It was $6 billion, now it's $4.7 billion. Sales of product went from $5.3 billion to $4 billion. Financing and interest is pretty much flat. Let's see if they give a breakdown of the revenue. Here's a breakdown of the product revenue. Agriculture went from $4.4 billion to $3.3 billion, down 25%. Construction, $950 million to $700 million, down 27%. Both segments down a lot. They talk about it right here. This decline was due to lower shipment volumes on decreased demand. It looks like their dealers had a lower inventory requirement, also unfavorable net price due to enhanced retail actions. I guess there was more difficulty in retail, maybe more competition. They give a breakdown of the $3.3 billion agriculture, $1.4 billion in North America, EMEA $900 million, $600 million South America, APAC $420 million, all down quite a bit. Here's a breakdown of the construction revenue, $358 million North America, $150 million EMEA, South America $136 million, that's down the least, APAC $42 million. Let's go back to the income statement. Below revenue is cost of goods sold, $3.1 billion. These are all the expenses directly tied to generating the revenue, all the costs to make the product. Then you have SG&A, $426 million. These are all the expenses not directly tied to making the product. R&D, $221 million. They spent $378 million of interest on their debt. Expenses, $4.3 billion. Operating income, $360 million, down from $660 million last year. $75 million of taxes, so their net income is $310 million. They did buy back stock. Last year, 1.33 billion shares, now 1.25 billion. Let's look at their balance sheet. Total assets, $44 billion. Their biggest asset is financing receivables, $24 billion. So when they provide a loan, that's an asset for this company. It's a liability for the company receiving the loan. They mention it right here. CNH provides and administers retail note and lease financing to end users in order to purchase new and used equipment. Here's a breakdown of the $24 billion. $14 billion is retail customers, $10 billion is wholesale customers. They also have $5.9 billion of inventory. They give a breakdown of the inventory, $1.7 billion of raw materials, $500 million work in process, and the last step is finished goods, $3.7 billion. As the inventory gets further down the process, you get closer to monetizing the inventory. Liabilities, $36 billion. Most of that is debt, $27 billion. If they give a breakdown of the debt, $10 billion of bonds, $4 billion in industrial activities, $6 billion financial services. Then you have asset-backed debt, $12 billion. Other debt, $5.5 billion. Assets minus liabilities equals equity, $8 billion of equity. They raised $1.4 billion from selling their business. They profited $10 billion from running their business. It looks like they bought back $1.4 billion of stock. Treasury stock is a contra equity account. It brings down your equity balance. That's why it's negative in parentheses. Let's look at a statement of cash flows. This is for the trailing 9 months. They only had $276 million of cash flow, which is better than last year. Last year they had a cash outflow of $600 million. It looks like they gave out a lot of loans last year, $1.6 billion. But they had a cash inflow of $500 million from people paying back those loans. And this year they had a cash outflow of $1.2 billion in trade payables. This means they bought on credit in the past and paid for it in this accounting period. In their financing section, they spent $330 million of CapEx. Last year, $400 million. In their financing section, they added $13 billion of debt. They added that debt to pay down $12 billion of debt. They paid out $600 million of dividends. Last year, $530 million. And they bought back almost $700 million of stock this year. Last year, $220 million. Let's look at Simply Wall Street. Its last price, $11, $14 billion market cap, up 13% in the past week. They must have had really good earnings, up 13% in the past year. It looks like they started trading in 2013 at $12, where they are today. Their low point was $5 in March 2020. It peaked at $20 at the end of 2021. It looks like this stock never really broke out. It just moves up and down in a pretty tight range. Simply Wall Street's valuation is 14. They say the stock is 17% undervalued. 19 analysts priced this stock at 13. They also say it's undervalued. Here's why the stock doesn't go up much in price. Their revenue is down. It was $34 billion in 2013. It never got that high again. It fell to $15 billion in 2020. It's currently at $22 billion, about 35% lower than 10 years ago. They had $30 billion of debt in 2013. It's currently $27 billion, and their equity is always lower than their debt, a lot lower. That's why they have such a poor debt to equity ratio. They only have 1.5 billion of cash on their balance sheet, which is probably just enough to pay the interest on the debt. They usually pay a pretty good dividend. It was 2.7% in 2015. It fell to below 1% in 2021, and now it's over 4%. The forecast is still over 4% in 2026. In the past year, one insider buy almost 500,000 shares, no sells. Just a few months ago, Scott Wine was appointed the CEO of the company. 69% of the company is owned by institutions and 29% by private companies. Their biggest shareholder is Giovanni Agnelli's fund, 29%. It's also the biggest shareholder in Ferrari. Second biggest is Harris Associates. Then you have some of the usual suspects: BlackRock, State Street, Vanguard, Mario Gabelli's fund, Gamco. Their employee count was 71,000. Now it's 40,000. So employees are going down. Not a good trend. And the ticker trades on the Borsa Italiana, BATS Europe, London Stock Exchange, New York Stock Exchange, Deutsche Börse, Wiener Börse, and Bulgaria. If you want to learn how to build your own DCF model, watch this video, and I also send you a free version.